After the statement of cash flows, now let's look at free cash flow. Cash is the most important asset for a company, and also cash is the most liquid asset. Many times, the company's value really depends on how much cash it can generate. And here it comes to the idea of a free cash flow. And free cash flow is the amount of cash available from operations and not from financing activities, as you can see, only from operations. And that is for distribution to all investors, including stock investors and debt investors. And also the free cash flow is after capital expenditures, and here it says um, necessary investment to support operations. And if we take a close look at the free cash flow, and first of all, it is cash flow, and we need to add depreciation back to net income to recoup the non-cash effect, as I have addressed multiple times before. Taxes are also part of the cash, and the tax paid will be deducted from your cash pool. And also, the word free is not only because the managers can use it freely for whatever reason, but also the calculation of free cash flow is isolated from a financial cost. We know that the company pay interest to debt holders or dividends to stockholders, and these are all cash flows. However, in the construction of a free cash flow, we do not really incorporate the interest or the dividends paid to the investors. So we don't count them as a part of free cash flow. We're going to count the interest and dividends as part of a cost of capital, which I will address in later chapters. So the free cash flow here equals to EBIT times 1 minus tax rate. As you can see, no interest is deducted here because it's free from financial cost. And also we need to add back depreciation to recoup the non-cash effect. Of course, it's after the necessary investment, so we need to deduct the capital expenditure. And also what we deduct here is the net operating working capital. While we know working capital is current assets, and the net working capital is current assets minus current liabilities. And the current assets are mostly inventories, account receivables that are related with daily operations, and also accruals, accounts payable are current liabilities, and these are also related with daily operations. So this should be included as part of the net operating working capital. In the category of current assets, there's also short-term investments in securities, and in the category of current liabilities, there's also notes payable, which are not operating related. So we are gonna exclude them from this net operating working capital. And when working capital increase, let's say if you build up more inventory, it's like you are spending more cash for that, and you're gonna have a deduction for your free cash flow. So that's why an increase in net working capital would have a negative sign because it's gonna reduce your cash. For more details, I'm going to cover it in the capital budgeting chapters in chapter 9 and 10. And what are the major uses for free cash flow? First of all, the managers can use the money to pay the interest to their debt holders and also pay the entire principal back for their debt. The money can also be used to pay dividends and also buy back shares that are already outstanding in the market. When the stock is repurchased, the stock price usually has a bump. And also, the cash flows can buy non-operating assets, such like marketable securities, investments in other companies, etc. The next subject here is taxes. And I'm not going to introduce a lot of calculations, formulas, because the tax code is subject to change. I just want to introduce a little bit about the tax situations in this country. So this is the table for corporate tax rates, and it is a little bit outdated because it's only up to 2015. As you can see, the tax rates are keep changing. It's not increasing steadily, monotonically. As for certain tax bracket, like here, let's see right here, between 100,000 to 335,000, the tax rate is pretty high at 39%, and then move down to 34, 35, and then you get back again to 38% after $15 million. And after the next break-even point, 18.3 million and up, the tax rate get back to 35%. And that was situation before 2015. The features of corporate taxation, first of all, it is a progressive tax rate, which means if you make, say, $100,000, so your first $50,000 will be subject to 15% tax rate, and then the next 25,000 will be charged at a 25% tax rate. Then the last $25,000 from 75 to 100,000 will be subject to 34% tax rate. It's not necessarily that corporate tax rate is higher than income tax rate, and sometimes the individual income tax rate could be higher than corporate tax when the taxable income is the same. However, as I mentioned in the first chapter, the corporations are subject to double taxation. That means for the corporate owners, not only do they pay corporate tax, but also they need to pay income tax after the profit. This is the tax rates for different countries in the year of 2019. And you can see that some other developed countries like France and Germany, they paid high rates, but not as high as the US before 2015. And when Trump administration took the office, the US tax rate is actually got reduced from 35% to 25.9%, and that was a pretty big deduction there. And some say that the tax cut contributes to the economic growth because corporations are more motivated to make money when tax is lower. You should also know that as a fact, US companies are motivated to utilize tax haven, and this tax haven could be a Caribbean island like a Virgin Islands or a Cayman Islands. All these islands have a very low tax rate, and these companies, the U.S. companies, we know they are U.S. companies because they have all their facilities, headquarters inside the U.S. land. However, their legal headquarters is located overseas in this offshore island, some place with a low tax rate like Ireland or Luxembourg. By doing this, they can, when they have an international income, let's say Apple, when they sell iPhones in China and got the income does not go directly to the U.S. headquarters, but instead go to the offshore headquarters and got stored there. And it could be used to invest in U.S. Treasury or other securities, but that money does not flow to the United States. And some other high-tech companies are doing the same practice by establishing offshore headquarters and evade the higher tax rate in the U.S. And here is another chart showing that the major U.S. companies have accumulated a lot of offshore profits from countries other than the United States, and the profits did not flow to the U.S. but are stored in their offshore headquarters.